been asked this question a great deal lately by current clients and new or incoming clients. What happens to an insurance company if it fails? And more importantly, what happens to your or my money if an insurance company fails? I'm going to blend that concept in with what happens if a bank fails, because we're kind of talking about the same thing. If we're talking about insurance companies and we're talking about annuities, then we're talking about safe money. So when people think of safe money, they think of the bank as well. First off, I want to understand something about security and guarantees. I'm always concerned with when someone uses the word guarantee. What's the teeth in that guarantee? I mean, what does it really mean? In the case of a bank or insurance company, what it means is financial reserves that are held back in place in cash or cash equivalent type securities to be able to make good on a promise or a guarantee made by that bank or an insurance company. In the case of a bank, they guarantee that you'll always be able to get your money back and never have a loss. They may also guarantee some predetermined interest rate for some predetermined time, but for the most part, one of the things that people don't know about the FDIC, which is the Federal Deposit Insurance Corporation, the FDIC is an independent corporation, it's not government. What the government has to do with the FDIC is they set the reserves required for a bank to have to be able to guarantee that your money will be in place. Also, what people don't know about the FDIC guarantees is the only thing that's guaranteed is your principal, not your earnings. So you could have earnings accumulating for a number of years, but the only thing guaranteed there is the principal. So that's a little piece of news. Now, let's talk about the difference between guarantees at an FDIC insured bank and guarantees at an insurance company, and then we'll move over into what happens if an insurance company fails. We're going to put IC, insurance company. We're going to put bank or the FDIC. Now, this is really important because Congress sets, and this is the only thing that Congress has to do with the FDIC, Congress sets the reserve requirements to guarantee your money in a bank. And currently, in the infinite wisdom of Congress, there is a $1.40 on reserve requirement to protect every $100 that's in the bank. Yes, $1.40 only to protect every $100. Now, it's obvious that somebody's not going to get paid if times were bad enough, but that's the requirement, and that's the reality of the guarantee with the FDIC. I'm not saying it's good, I'm not saying it's bad, I just think people need to understand that. With an insurance company, insurance companies are regulated by the State Insurance Commission. State Insurance Commission requires that there is $1 in reserve for every dollar on deposit. So here we have dollar for dollar reserves, and here we have $1.40 for every $100 reserve, 1.4%. If you think that's enough, fine. I'm not here to pick on banks. What I am here is to disclose information. Now let's get down to insurance companies and what happens if an insurance company were to fail. You notice I didn't use the word if an insurance company files bankruptcy. A lot of people like to use that word bankruptcy, not really understanding the difference between bank failure and bankruptcy. Bankruptcy means lost, out of business, gone, kaput. Failure just means the bank failed, and here's the way it works. Every insurance company operating in every state that I know of, in this case Virginia, but every state that I know of, has a guarantee association, means there's an association managed by the state, number one level of protection, that guarantees up to $250,000 in an annuity contract if the insurance company were to fail. That's the first step. Second step, that guaranteed association is seldom used, and here's why. Because also the state requires every insurance company offering annuities in the state to reinsure all the other insurance companies that are offering annuities in the state. Here's what that means. If you have money in an annuity with insurance company number one, and there are, I'm going to make this number up, 25 insurance companies offering annuities of that type in your state, that means all the other 24 insurance companies have to reinsure insurance company number one. Insurance company number one has to reinsure insurance company 2 through 25. So, if your insurance company fails, it is automatically taken over by the sum of the other insurance companies in the state. The State Insurance Commission will assign out the contracts and or policies of that insurance company, assign them out to the other 24 insurance companies remaining. That's why I can say this. It's factually correct. There has never been an insurance company in the United States file bankruptcy. State Insurance Commission won't allow it to happen. What happens is if the insurance company falls below their reserve requirement to satisfy the requirements of the actuaries of the state, then the State Insurance Commission will take over that company, reorganize it, and assign out those contracts to somebody else. And a perfect case in point, not too many years ago, back in 1996, Executive Life, a California-based company, failed. Its reserves fell. They couldn't be brought up to solvency. All the contracts and policies of Executive Life were assigned out to all the other insurance companies in the state of California, North Carolina, Virginia, Massachusetts, wherever those insurance policies were assigned out to all the other insurance companies. So what that really means is if you put aside the State Guarantee Association, because that seldom gets needed or touched because of this reinsurance with all these other insurance companies, as I mentioned, what you really have is you have your money with insurance company number 1, but you're really ultimately protected by insurance company 1 through 25 because of this reinsurance process. So not only do we have reinsurance to make the insurance company really stronger than the bank and a no-fail situation for the public, but we also have a dollar for dollar in reserves, which are much stronger certainly than the FDI insurance at the bank. Now I want to point out something to you that between 1987 and 2009, there were 74 insurance company failures. Between 1987 and 2009, only 74 insurance company failures. They were all protected in the way I just described. However, in 2010, there were 157 bank failures in 1 year, and another 92 bank failures in 2011. So in 2 years, there were 249 bank failures in just 2 years. Now, do you think if bank number X closes in failure, do you think bank number B steps in and reinsures them? And the answer is absolutely not. That's when it falls into the lap of the FDIC. So I hope I clarified a little bit in what might have been in your mind what happens if an insurance company fails. Using the bank as an example, because I think that's appropriate. Both banks and insurance companies that hold your money, they hold your money in a no-risk situation, so you don't have the risk of loss, so they're safe money entities. But the reality is to consider them safe money entities, I really think we have to look at the teeth that are in the guarantees that they make. Well, thanks for listening today. It was fun. I hope I can bring you more meaningful information in the next few days. So in the meantime, happy trails.